It's a video on the United Parcel Service, UPS, as part of the continuing featured stock series brought to you by PolarisInvesting.com. Reminder, PolarisInvesting.com is a site to go create defensible valuations, and the model used by the PolarisInvesting.com site, like any other financial model, is primarily best used to approximate your thinking, and it does rely on assumptions that do not hold perfectly in all situations, so it's important to go through as you go through your assessment. As we go through this assessment today, we'll be looking through some of those assessments, primarily the default values used by Polaris. The other thing I'd like to point out is at the bottom of this welcome screen here is a graph that shows that really the purpose of valuation is to improve the likelihood of a higher investment return. And if we let this, think of this linear line here representing the valuation, intrinsic or business value over time that we come up with from the PolarisInvesting.com website, and then the oscillating line, which represents the market. Now, the market obviously doesn't move in such a smooth way, but it does represent that it reaches peaks and valleys. And so what you really want to do is you want to ideally identify a stock that's underpriced by the market, and then by doing that, you increase your chances of likely return. So if you were to pick a stock that the current price is right on the assessed business value, you would be looking at returns that would normally be in this range where the green dot is here, but knowing that returns are somewhat normally distributed based on random events going on at any given time, micro or company specific events, you could see a range around that midpoint. But by picking a stock that is underpriced by the market based on the business assessment of business valuation, you're actually increasing the chances of a higher return. And then with that same normal distribution, you get a range of returns that are on the whole higher than what they would have been if you would have picked one when the stock price of the stock was equal to the business value. This difference between the green and the red line is the alpha that we're attempting to identify. So you not only get the risk-adjusted rate of return, but you also pick up a little bit of alpha by buying a stock that's currently underpriced. Now, as we do the valuation, reminder, the valuation formula used by the Polaris Investing website is this formula here. And the inputs that are used, a lot of them are fairly straightforward inputs. Then we hear the dividend, and then we just take 5 years for the number of years that we expect to receive that dividend. So that's readily available information. Current sales, you can look that up. Then you assume a certain growth of sales, which the website allows you to modify that important input value. It does default to a value. You can see here for United Parcel Service, we're assuming an 18% default value for growth. Next, it uses profit margin, future shares, which are, for most companies, particularly companies that are considered stable, which we'll get into in a second, but UPS is classified by the Polaris.com website as being a stable company. That those values are fairly straightforward based on historical trends. But then you multiply by a future PE, and then discount that back by a calculated historical, based on historical price movement, cost of equity. So the main value that's questionable is the future PE, and that's why the Polaris Investing website assumes mean reversion, namely that the return on projects will eventually equal the cost of capital out into the future. And by assuming mean reversion, we avoid any specific assessment or forecasting of the price earnings multiple. There are techniques to do that involve regression, using maybe representative companies in the industry and getting some idea of what, based on that regressed formula, and then you plug in specific values for the UPS, you could come up with what you think would be the future PE. You could look at the historical average PE. Numerous ways that people have tried to come up with specific PEs into the future, but Polaris doesn't do any of attempting to forecast a specific number. It just says we're going to pick a floor. We're going to say we believe at a minimum the PE will equal this into the future. And by picking a minimum, that also serves as a margin of safety that says that being very conservative with the future PE through mean reversion, we know we're ending up with a valuation that's going to be lower than what would be otherwise, but it again gives us a margin of safety. So the Polaris model is based on kind of degrees of predictability, that these input parameters over here are more predictable, including the growth of sales, because you're looking over the next 5 years. But the future PE is a value that really is 5 years out and applies to the time frame that extends well beyond the 5 years. So it's less predictable. So again, by using mean reversion and using a floor value as opposed to try to be specifically forecasted, we just go with a floor value for it. All right, so going to the Polaris website, we see, as a reminder, there's a date here of when this recording was made underneath the name of the company, and you'll see in the title of this video it's appended with the word either prospect or suspect. Prospect means that there was enough good things noticed during this short assessment that it's recommended that you, the investor, consider the stock further as a possible choice of investment. But if suspect is appended at the end of the video, title of the video, then it says that we've noticed something here that would warrant it not being considered right now for an investment. All right, so to get going on the actual assessment of UPS, we notice that the practical investment return with the default values is 14.8%. So on the surface, this looks very promising as a potential prospect, but we need to look further, particularly into the input values used by the model. Before we get to that, though, let's look at the fact that Polaris is categorized UPS to be a stable company. Stable means that you can rely more on the historical numbers to reflect, at least here in the immediate future, next couple of years, what's likely to expect. Stable means that we've looked at the financial consistency of debt versus equity, and it's been fairly stable over the last couple of years. R&D spending is reasonable. It's not like a startup where a lot of the earnings isn't as high as it could have been because you're expensing off all of a large R&D. So we got more stable R&D being expensed year to year. Other things like that make it Polaris assess it to be a stable company. Price momentum has to do with over the last 3 months. You can see here that relative to the overall S&P 500 index, that the price has been a little bit down, but we got to look at what's going on in the marketplace. Over the last 3 months, we've seen the overall market, which is this lighter blue line. We've seen a fairly significant drop-off in the overall market of almost 16.5%. UPS has gone down even more than that, 20%. But when you compare it to one of his company that people often think of when they think of UPS, and that's Federal Express. Federal Express is down even more dramatically than UPS in the market overall. Now, I believe it's incorrect to assess or to think of UPS and FedEx being really that close in competitors. Yes, they're both in logistics and trucking and shipping and that kind of thing. But FedEx is more about long distance shipping, and UPS is more about kind of the final mile or short-term shipping. Now, some of the things that are headwinds for UPS are Amazon and other, even Uber is looking into getting into more short-term delivery, and what that could do to UPS's business is uncertain. So that's got to be factored into the overall assessment that we're doing here. So let's look at some of the input values that were used by the model. The primary input value is the sales growth. You can see here default to 18%. Now on the surface that seems like a fairly high sales growth to assume annually for the next 5 years. So to get some idea of whether that's in the ballpark of what's being forecast by other analysts, go out here to the CNN site. You can see here that the annual sales growth rate is about 9.5% versus the 18% that's being assumed on the Polaris Investing website. Now, while we're out here on the CNN site, look at the EPS growth that's being forecasted by these analysts. It's almost more than twice of what the annual sales growth forecast is. Well, in order to get earnings growth that's larger than sales growth, it means that either operating leverage or financial leverage is being assumed to equate to a higher profit margin going forward. So it assumes that fixed costs, which is operating leverage, and debt and borrowing is already in place. So as you do incremental sales, not having to increase either one of those too much, and therefore you get much higher earnings growth, because you're just leveraging fixed investments that are already in place. So we'll see that in the analysis. Let's go over there and look at how that shows itself in terms of profit margins. We go down here and look at what's being used by the model in profit margins. We're assuming a future profit margin equal to the current profit margin. Well, if we were going to be more like the CNN site, we would assume a higher profit margin going forward, because again, of the financial leverage and operating leverage. Well, let's look at the historical profit margin, and that's being shown here. And over the last couple of years, you can see here that it's averaged out to about 6.8 or 7%, but it's been as high as 8%. But here recently, it's been dropping down into about the 6% range, and that's the big risk factor as Uber and Amazon, companies like that, do more in the final mile delivery, is whether it will continue to put pressure on UPS's profit margins, or whether the profit margins will eventually go back to around more like where they have been, 8% or so. Well, 6% versus 8% is a 25% difference in profit margin. So that really comes out to be one of the main factors that have got to be considered when you think about UPS. We look at the other input values, share trends, doing some buyback year over year. That seems reasonable. And then the future PE that's being used is we look at the tooltip. You see here that you can calculate what the future cost of capital that's being implied by that PE number by just dividing 1 minus the PE. So that's roughly 1 divided by 11. Or excuse me, 1 divided by 12. So we're assuming about a little over 8% cost of capital, which we were assuming here for the calculated cost of capital based on historical price movements relative to the overall market. We were assuming 7.9%. So we're assuming that to pretty much stay the same as we go into the future and use a future PE. And like I was saying in the intro of this video, that really the future PE, by assuming mean reversion, is a low mark. We want to be very conservative with that. So I think a 12.8 is a reasonable conservative value that gives us a margin of safety that we should just stay with. So main two things we want to consider is whether we want to adjust the sales or adjust the profit margin. Well, I think it's reasonable that we can go down to more like what the CNN site is saying, which is 10%. But the profit margin likely will get back to 8% is what I'm assuming. So that's a 25% increase in this theoretical value, and that gets us back up to about 125. So if you watched other videos, you know that just by moving this to, you see 125 or so. And that just takes us right back to where we started at, with about with a 14.8 theoretical investment returns we had with the default values. And that seems like a reasonable number based on a quick view of the input parameters. And so we compare that, and we go back to the CNN site briefly and just scroll up here and see what kind of range these analysts have forecasted. We see mid-range of 125 all the way up to a high of 145, and then also a low here of around 90. But 125 to 145 on the upside. Polaris is picking a present value of these future cash flows to be around, from a theoretical or practical standpoint, to be 128. So we're kind of in the middle of that range that CNN's offering up. So that's consistent. So I think 14.8 or close to 15% return is over the market return of around 8%. So you're getting about a another 7% bump in alpha by virtue of this pricing. So we definitely are over here where we feel like we've caught a stock that's got a significantly lower price than what the current business value is, and therefore our likelihood of success is greatly improved. So we're going with a norm of shooting for a target of about 15%, knowing that it can returns are normally distributed for stocks, so that we can, but again, we're going to go with a 15% normalized return, and hope that the events play out. So with that assessment, I'm going with UPS definitely prospect.